Okay, how you doing, guys? Today we're going to learn about mortgages, which is just a fancy name for a home loan. And it's a good thing to learn. I remember years ago when my wife and I first decided to buy a house, we had no idea how much money we could spend. You know, we didn't know if we could afford a $50,000 house or a $150,000 house or a $500,000 house. We pretty much figured we couldn't afford the $500,000, but you know, no matter where you are in the country, there's a big difference between a $50,000 house and a $150,000 house. So, logically, I called up a good friend of mine who was a realtor, and a successful one. And I made a lot of money, and I thought he'd be the call to make. And he had no idea. He had no idea how to tell me how much money I could afford. So, I called another realtor, and I got exactly the same answer. And so I decided that this was some kind of state secret that I wanted to know about. So I bought a book. I bought a book called Personal Money Management 101, written by a guy named David Brooks. And in the next couple of minutes, I'm going to teach you exactly how to figure out for yourself how much house you can afford at any given point in your life. It's real easy to do. And we're going to talk more about that book too, because I learned a lot of other things from that book. How to figure out the payment on an auto loan, how to pay your home loan off early, and other really, really good things. So we'll talk more about that book in a little while. But right now, let's teach you real quickly here, this isn't going to take long, how to figure out how much house you can afford. Now, a couple of real quick definitions for you. Mortgage. That word simply means, that's the word that represents a home loan. A loan on a house is called a mortgage. Pre-qualification, all we're doing here is we're figuring out how much you can afford before you actually buy. So we're pre-qualifying you. That's the big buzzword mortgage lenders use. Okay? Or how much house you can afford to buy. Alright? So, let's take a look at what we need to do. Alright, what we're going to find here is that lenders use a system that is a two-step or two-pronged formula. Okay? And what they do is they say two conditions must be met. Two conditions must be met. The first is this: your monthly mortgage payment, that's the payment you make on your house, cannot exceed 28% of your monthly gross income. Okay, it's logical. I mean, you've got other things you need to spend your money on. So they put kind of a ceiling on how much you're allowed to spend on your home, because you've got to buy food and clothes and drive a car and buy other things too. And that ceiling is 28%. Monthly gross income is simply how much money you make per month before taxes are taken out. The word gross represents pre-tax dollars. So, again, your monthly mortgage payment cannot exceed 28% of your monthly gross income. Condition 1. And, not or, and condition 2, the total dollar amount of all your monthly payments, including the mortgage payment, cannot exceed 36% of your monthly gross income. You with me on this? So you're going to have, maybe a car loan, a student loan. If you have credit cards, they will use the minimum payment that you owe on that as well. They'll add them all up, and that number, including the mortgage payment, cannot exceed 36% of your monthly gross income. Everybody with me? Good. All right, let's keep going. So we know this is what they're going to do to you, and what they're going to tell you. Now, let me give you an example. Let's say you make $42,000 a year. All right. Everybody knows how much money they make per year. You simply take that number and you divide it by 12. That's your monthly gross income. So if we take that $42,000, we divide it by 12, we get $3,500. We know that of that $3,500, only 28% is going to be allocated, is allowed to be allocated towards your mortgage payment. 28% of $3,500 is $980. So there it is. That's what your monthly mortgage payment can be maximum. That's the most a lender will allow it to be. $980 a month. That has very little meaning to you right now, but it will in a moment. Okay, now, second condition, 36% of all of your loan payments, including the mortgage payment, is the most a lender will allow. 36% of $3,500 is $1,260. You with me so far? All right, now I have a question for you. Remember, both conditions must be met. If your mortgage payment is $980 a month, right on the button, and you have a vehicle payment of $500 a month, that going to be okay with the lender? No, because you've exceeded the 1260, right? In other words, what's the maximum amount, here's another way to ask it, what's the maximum amount of your mortgage payment if you have a $500 a month vehicle payment? What's the most your actual mortgage payment can be? Anybody?
$760.
$760, that's right. Good job. What we're going to find, and we're going to talk about this later, is that vehicles go down in value, and houses almost always go up in value. So what I'm going to try to talk you into is having a small vehicle payment and a bigger house payment, but we'll get there at a later time. Anyway, you understand the concept so far? Okay, good. All right, so there's our example. Now, I want to make sure you understand something here, because when I say mortgage payment, I'm sure you're assuming that I'm talking about just the money you send to the lender every month to pay the loan off. You're partly right. But a bank defines that term mortgage payment to also include some other costs. Anytime you own a home, you have to pay something called property taxes. You also have to buy insurance for it in case something happens to it. And what the lender wants to make sure is that when you figure in the monthly property taxes and the insurance and put that number on top of the loan payment, that is what they mean by mortgage payment. All right, so I just want to make sure you understand that. It's all three added up. Property taxes vary to a great degree in different parts of the country. In this part of the country, I'm just going to go ahead and use a reasonable number here. I'm going to use $200 to represent both your property taxes and your homeowner's insurance together. All right, I'm going to take that off the $980. So now the loan part of our payment can only be $780. You with me on this? You have to back out the property taxes and the insurance. All right, now, from there we work backward off the number. Okay? We know now $780 per month, assuming you don't have many other loan payments, is the most our monthly mortgage payment can be. So, here's what you do. Very simple. We're just about done. You go ahead and you find the current interest rates. And interest rates move up and they move down, but they move slowly up and down. And so you can call your local bank and ask them what the current interest rates are on mortgages. You can look in the newspaper. I happen to look in the newspaper that I read. And I got this morning. Today's interest rates, and this is a real number, on a typical mortgage, 4.84%. Okay? These interest rates, by the way, historically have ranged from a high in the 1980s of, I think about in the teens to the high teens. The highest they ever got historically was about 25 years ago. And right now at 4.84, you're very close to the all-time low. Good time to buy a house. But anyway, right now they're at 4.84%. Okay? The next step you take after you've got that number, very easy to acquire that number, the next step you take is you go to Google, you write in the words amortization schedule calculator in a little box there, a little Google box. You don't have to know what those words mean, just write those words in. And this is what you'll get. You'll get, click on the first free one, and you'll get something that looks like this. There'll be a bunch of them there. Okay? And this will do the math for you. Now, we know that $780 a month is the most that our payment can be, right? Okay. Here's what we want to do now. The first thing you want to do is you want to plug in the current interest rate. And we know that's 4.84%. Most mortgages in America today are 30 years in terms of the loan term. We can have a detailed conversation about that at a later time, but typically they're 30-year mortgages. Leave that alone. You want to take the credit score and make it excellent. You want to make it excellent, all right? All we have left to do now is to put in how much we're borrowing. And again, that's the whole story here. That's what we're trying to find out. How much can we buy? How much can we borrow? Well, we have no idea, so start somewhere. We know that 780 is where we're going to end up. Let's start with $100,000 and let's see where we get. It'll do the math. Here's the payment up here. Ooh, $527. Wow, that's nowhere near 780. So we're looking at over 100,000, aren't we? We're doing good. Let's go back and try it again. Let me plug in 150. And let's see what we get. 790, a little bit over. So we're just under 150. We just realized, or just determined, how much money we can borrow. It's going to be in the mid-140s. Now, from there, it's easy. If you have $10,000 down payment, add that to the 145, and you have $155,000 purchase price. If you have $25,000 to put down on the house, add that to the 145, and you've got $170,000 purchase price. Very simple, very basic. Teach your realtor this as they're driving you around showing you the houses. They should know it. Any questions? Thank you very much. I killed it.